Good morning, Mike. So one of the places we are seeing those stresses play out a little bit more, even so today with the market going the way it is on the corporate credit side of things. And we have seen a pretty big divergence that's maybe starting to shift a little bit towards a wholesale sell-off of the market. But there are certain points that certain investors are paying attention to. They're looking at bond insurance, something called credit default swaps. And we've seen some of the hardest hit or center point industries within the coronavirus whole kind of market dynamic play out there in those bond insurance markets. Now, these are credit default swaps on places like in travel and tourism, say with the cruise line operators. Carnival Cruise Line, it now costs about $650,000 a year to insure $10 million worth of corporate debt from Carnival. Also, places like in the oil and gas industry, Hess is a fairly decent-sized, large-sized producer, integrated oil company. Some of those particular bond insurance pieces are now charging about over $500,000 a year to insure $10 million worth of bonds against default. On the other side, consumer staples companies like Clorox, they've actually seen their rates fall, meaning it costs less to insure against a possible default on a company like Clorox than it did just about 2 or 3 months ago. Now it's pretty much below $50,000 a year to insure $10 million worth of debt. I spoke before a little bit about the kind of divergence that we had been seeing over the course of the past several months now in certain parts of the bond market. If you were a highly rated bond issuer or company, Jim Cramer mentions Johnson & Johnson a lot, companies like that, well, their costs have generally over the near to medium term been coming down in terms of their interest rates. Meanwhile, some of the more highly risky issuers, those that are rated CCC, those particular types of bonds are now yielding a lot more. Investors are claiming, and they want a lot more yield for those. If we do see that dynamic start to kind of shift a little bit, that could be a key place to watch for stresses in the market. And guys, I would just note here that as the volatility plays out in the stock market, we have not yet really seen a lot of the stuff that would happen in very, very stressed out credit markets. So it's certainly a flashpoint, guys, a focal point to watch.
Yeah, for sure. And obviously a lot of attention on the investment grade credits that might be subject to downgrade and all the other kind of chain reactions that sometimes kick in.